From our point of view, the fundamentals are still very much there. We think the AI boom is not a bubble, it's a boom, is going to run for 5 to 10 years.
Market review and outlook.
Nick, I can't believe it's that time of year again. I feel like we've blinked and we're back here talking about the year in review. This time last year when we sat down, you said that 2025 was going to be the third year of the bull market and that performance wouldn't be as strong as 2024, but positive nonetheless. How has 2025 played out, and did performance play out that way as well?
So short answer is yes, it played out as we thought. It's important to maybe go back and talk about the narrative here. 2022 was a bear market. NASDAQ fell 33%, medium stock fell 50%. So that was a proper bear market, particularly in growth investing and what we do. And proper bear markets clean out all the excessive risk taking that's been going on for a long period of time. 23 and 24 were recovery years, and they were both 20% plus years for markets. And that's normally what you expect. The best period is the recovery. And then we said year 3 would be double-digit returns, and that we felt that we could produce solid double-digit returns, but it would be volatile. And that's sort of what we got. We sit here, this is end of November, coming into December, and you got markets generally up between 10 and 15% for the year, depending on where you look. Global markets roughly 13, 14% for the year, and thankfully all of our funds doing more than double-digit returns for the year as well. So from our point of view, played out roughly as we thought it would.
So as you mentioned, 2025 was a very volatile year, and it started off right in January with DeepSeek, and then later that month with Trump's inauguration, which ultimately led to the Liberation Day and Trump tariffs. Can you tell us and talk us through how the team navigated those very unprecedented few days in early April?
Yeah, so look, it played out how we thought we did, but I didn't say it was going to be fun along the way. There's always twists and turns. The plan comes together at the end, but it never feels like it along the way. There were a lot of twists and turns this year. I think for us, DeepSeek was just an excuse to correct the AI trade from our point of view. Ultimately, we need the cost of these models to come down for AI to proliferate. We're probably going through another one of those excuses right now with the AI bubble question, which I'm sure you're going to ask me.
Definitely.
And it's important to remember that, that stocks don't go up in straight lines. If the AI trade, if everyone believed it all at once, then you would be in a bubble, but no one believes it, and that's not necessarily a bad thing. For us, the big one was Liberation Day. I mean, we really were blindsided by that to a certain extent. We thought that Trump would be net positive markets. We sort of probably failed to understand that all the bad stuff would be front-loaded. From our point of view, how did we navigate that? We leaned on our stop-loss processes. I think coming into the year, we would have talked about a broadening out, i.e. that Trump would be positive markets and positive the economy, and that rates would come down. And what really happened is tariffs sort of muddied that water, and ultimately the economy didn't recover at the speed that us and other people thought it would this year. So from our point of view, we had to lean on our process. A lot of those broadening out trades, we ended up stop-lossing, particularly in the consumer area, for instance, where the consumer just hasn't recovered this year. And that money rotated into areas of earnings certainty, to things like Netflix and Spotify, which have been good for us this year, and also rotated back into the AI trade, or some of these AI investments that had corrected quite dramatically through that period. And so ultimately we lent on our process through that period, which ultimately helped us get to this end point, which is double-digit solid returns for the year, which we're very happy about.
So before we dive more into the AI bubble question, would you highlight any other portfolio decisions that were particularly meaningful throughout the year?
Look, from our point of view, we had a couple of, the big challenge has been to find these broadening out trades, to find other areas of structural growth that are somewhat not correlated to this whole AI trade that everyone is always going to ask you about. And so we're running roughly, you should think about roughly 40% of the portfolio probably directly exposed to AI, and roughly 60% not. So more than half of it is looking for these other ideas. Some of those did not work out, like we talked about, some of these consumer ideas, etc. But some of them did. And so for us, the really heartening ones for the year were we participated in the CATL IPO, or the CATL IPO in China, and that was an IPO of the largest battery maker in China. And we see batteries as a structural growth area around electric vehicles, trucking, solid state storage, etc. That's been a very successful contributor to the fund this year, and gone up more than 50% this year. The second one was a company you might have heard us talk about before in Galderma in healthcare. a leader in dermatology and fillers effectively. This is again a differentiated structural growth area that did well this year, as did a number of our other healthcare ideas. And so from our point of view, the highlights for me are always the new things we found for the year and a good smattering of new things out that what we found this year that helped contribute to the double-digit returns I'm talking about.
So now coming to the AI bubble question. As a lot of people would know, Munro were early adopters of AI and invested as early as when ChatGPT launched. There has been a lot of discussion about whether or not the markets are in a bubble. What are your thoughts on this?
Yeah, so importantly, going back to what I was just answering, AI is actually the predominantly driver of performance again here in 2025. So the best performing stock at this point of the year is still NVIDIA. It was NVIDIA last year and it was NVIDIA the year before. So we have done well to stay on this investment theme. The other important driver of performance for the year has been the power side of it. So some of our ideas around GE Vernova and Siemens Energy, et cetera, how we're going to power the AI trade. So we've been firmly on this trade and it has driven performance for the year. So then are we in a bubble? Okay, so why don't we just knock these off one by one? Generally, when I hear the word bubble, the bubble means a valuation bubble. And that's pretty easy to knock off here. We're definitely not in a valuation bubble. I was in the last bubble, okay? The last bubble in 1999, the NASDAQ went up 95% that year. The NASDAQ's up just over 15% this year, okay? So that's not a bubble. Secondly, big stocks traded at 99 times earnings. The biggest stocks in this investment are trading all below 30 times earnings. Even Google, the best performing idea this year, is on like 26 times forwards earnings. So there's no valuation bubble here. I think most people would agree with that, at least amongst the biggest companies. Yes, there's elements of froth in things like quantum and crypto, et cetera. That's fine. We want that froth washed out. We need that froth washed out to keep the whole thing going. So there's definitely no valuation bubble. Is there a spending bubble? And so that's the next question. And clearly we're 3 years into this spend and hyperscaler CapEx continues to go up. But we would argue that they're spending because they have demand. They're spending in terms of demand signals. There is demand for compute. I think the really heartening thing from our point of view is everybody is using AI. Everyone's trying to use AI more and more and more. People who use ChatGPT would run out of credits, if that makes sense. So people want to use these products. That's a great thing. So you're not building for people who don't want it. You're building for people who do. And so we think all of this spending has a return. Maybe not a return you'll see turn up straight away, but a return that will turn up over time. And we can point to countless areas of evidence here, whether it's Meta's accelerating revenue growth or whether it's Microsoft's Copilot adoption. There are countless areas where AI is being adopted and the spending is being rewarded. And so from our point of view, if the spending continues to go up, that makes perfect sense to us because you're ultimately supplying the copious amounts of demand that are out there.
So you're saying ultimately the fundamentals are still there?
From our point of view, the fundamentals are still very much there. We think the AI boom is not a bubble, it's a boom, is going to run for 5 to 10 years. And the best way for clients to think about this is, here in Australia, we lived through a super cycle, okay? Do you remember the super cycle? China spent 10 years building infrastructure. In that 10 years, we built iron ore mines. We opened up lots of capacity across the US, across Australia, resources, oil and gas construction companies, et cetera. And that boom pretty much went for a decade. Eventually it ended. We're only 2 to 3 years into a data center build out, to supply all of this compute for AI. And we think it goes for 5 to 10 years, and it's just way too early to be thinking about overspending today.
So I was going to ask you for some highlights for 2025, but you have already answered that. So maybe on the flip, could you give us a few learnings from the year?
Look, stick to the plan, stick to the process. I mean, the plan we had for the year ultimately worked. In the depths of April, it didn't feel that way. But on top of that, we did make, as usual, our fair share of mistakes every year. We always do. And our processes kick in. So the ability to stop loss, the ability to review and recognise our mistakes has ultimately allowed us to remove the mistakes this year and also gravitate towards the winners. As we go forward, which I'm sure we're about to talk about, that's the stuff that keeps you in good stead because the world will keep changing and we need to keep changing with it.
And so just like that, looking at 2025 is over and it's now time to look ahead to 2026. Will 2026 be the fourth year of the bull market? How do you think the year will start?
So short answer is yes. We're sticking to the narrative we've been running now for 3 years and don't see any reason to get off it. From our point of view, 26 should be better. A lot of the things I just talked about are more likely to happen in 26 than they did in 25. And so the two I would point to is one, the Trump policies will start to get more traction in 2026. So you'll get better, the deregulation benefits will come through, the big beautiful bill taxation depreciation benefits will come through. And on top of that, we would expect, accelerated M&A. We do expect, a lot of these companies, if they want to buy their competitor, they've basically got 3 years left of the Trump presidency to get it done before they might be dealing with a different administration. So all of that good stuff should come through. And then secondly, the rates should come down. I think, I struggle with the inflation argument, I really do. Tariffs obviously delayed the coming down of inflation, but we're now seeing them being rolled back, particularly on food items. Oil prices are lower, so rates should come down. So we should, in theory, eventually get this broadening out of the economy. That's all still in front of us. And it has been a little delayed here in 25, and so that's why it was a harder year. 26 should be better than that.
And so are there any other key catalysts that the team are looking out for in 2026? Are the midterm elections important to you guys?
So yeah, they are. And again, this comes back to, sort of slightly more market-friendly policies. The midterms, the Republicans want to win the midterms. That's why they're rolling back tariffs on foodstuffs. That's why they're handing out $2,000 tax break checks. So all of this is going to help the economy. And it's important to understand that, we got these double-digit returns in 25 without any help from the economy at all, like none. And so many sectors have been bad. We talked about consumer and some of these other different areas that just haven't been that great because you haven't had a lot of help from the economy. It's basically been AI and a couple of these other idiosyncratic things I talked about. It would be really nice to get a bit more help from the broader economy, and I think we think that's going to happen in 2026.
So you are ultimately feeling more positive about the macro and the US economy specifically?
Yes, and not just the US economy. It's important to flag that we are seeing, a bit of a detente between US and China, so China can continue to do better. We talked about some success we had with the Chinese stock in 2025. I'd expect more successes in 2026. We also haven't talked about this much, but the European defence build-out, the European infrastructure spend is going to really kick into top gear in 2026. So you will get continued this massive infrastructure spending coming out of Germany. Germany is going to really kick in 2026. And on top of that, you're still seeing continued reforms in Japan. So not only just a broadening of the sectors that will hopefully perform, but also a broadening of the countries that will hopefully perform. And that did start a little bit in 2025, and we'd expect that to continue. So there's just lots of more reasons that, a lot of the reasons we were positive about 25, but it sort of got delayed, will definitely start to show up, we think, more in 2026.
So how are you positioning the portfolios for all this?
Yeah, so from our point of view, we still believe in the AI boom will continue, and we want to benefit from that. The simple way to think about that is we're building out all of this data center capacity to satisfy all this compute demand. That's trillions of dollars of spend in data center capacity. That's trillions of dollars for the revenue and companies that help enable that. So that comes down to things like TSMC that make chips, NVIDIA that designs chips, power companies that are providing the power, networking companies, even down to the construction companies that are helping build these data centers. We still think this is an important theme. As I said, it drove the returns last 3 years. We think it will continue to drive the returns in the next year, but to a lesser extent. Beyond that, we will, again, try to broaden the portfolio out across different regions and different sectors. And from our point of view, continue to try and find these other idiosyncratic structural growth areas. The big ones for us in the last 12 months have been really around sports, with the increasing value of media content of sports rights, and also around things like defence, where we see defence spending continuing despite, even if the Ukraine war ends, there's going to be a significant build out there. And then lastly, as I flagged before, consumer financials, M&A, all these things are going to broaden out as 2026 goes on, and a lot of these stocks have not done well in 25, so they do set up as really quite good opportunities here.
And so before we round out the end of the video, I'm just wondering, do you have any last overarching messages you'd like to leave with our clients and investors, to talk about either, the year that's been or the year that lies ahead?
Look, I think from our point of view, obviously, we've done these videos 3 years now, Taylor, and we've gotten them right every year. Next year, we think we'll actually be better than 25. We really do. There's enough reasons to suggest, and there's enough parts of the market that haven't performed that's going to give us that opportunity for the earnings growth to drive the share price growth, and earnings growth should accelerate next year. Like S&P earnings growth could be 15% plus next year. So if the multiple's the same, the market's going to do more than 15, and we see other opportunities elsewhere. So that's I think the important message. But the last message is the key one, is like, if the facts change, we change our view. Okay, we have a process here. 25 was not smooth sailing. We've talked about it. The process enabled us to eradicate our mistakes and move towards our winners. And if the facts change again, you know, our process will kick in again. And so from that point of view, obviously we're saying what we think, we're being brave and telling you. So far it's been right. I sincerely hope it's right again, but also be comforted that there's a process in place for when it's not. And I'm sure we get to this time next year, there's going to be a lot more twists and turns, I guarantee it. But hopefully the outcome is as predicted.
As you say, I look forward to sitting back in this very spot this time next year to talk about all those twists and turns. But until then, Nick, thank you for a wonderful 12 months, and I look forward to chatting next year.
Thanks very much, Taylor.